You are listening to Keystone's Stock Talk Show, episode 265. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. It's great to chat with you again. You'll be happy to hear that Mr. Aaron Dunn is back in action this week. I will kick off the festivities with a look at when Canadian and U.S. public companies or stocks are required to file their annual and quarterly financial statements. In our Your Stock Our Take segment, Aaron will lead off with a look at Boardwalk REIT, symbol BEI.UN on the TSX, which currently owns and operates more than 200 multifamily residential properties located in Alberta primarily, but also Quebec, Saskatchewan, and Ontario. The REIT has more than doubled since our original recommendation in 2021, and Aaron lets you know what is powering the strong move in a tough REIT environment. Brett answers a viewer question on little-known Canadian financial services company Olympia Financial Group, symbol OLY on the TSX. The viewer points out that it is totally underfollowed, profitable with a high dividend, well covered by income, but terribly illiquid. Can you give me your take on the business? Brett will do that. Finally, Brennan answers a viewer question on Trigon Metals, symbol TM on the TSX Venture, which the investor suggests could be a 30 bagger. Brennan reviews Trigon, a copper miner, which holds an 80% interest in a property or project called the Combat Mine property, which consists of 5 mining licenses and 2 prospecting licenses located in northern Namibia. He will let you know if the stock meets our criteria as a potential 10x stock. So let's get to the show. I'm going to welcome my co-host, Mr. Aaron Dunn, the Killer Bees, Brett and Brennan. How you guys doing?
Doing well.
Doing good.
Great.
Good. I'd like to say you're going to get news on this. Anybody who subscribes to our podcast, we're launching new webinars upcoming, how to find the next 10x stock. So stay tuned for details on that in your email inbox and likely just sent off to you this week. Anybody now, Aaron, you're back. Have a good vacation.
That was pretty good. Yeah. Relaxing.
Good to hear. Good to hear.
You guys missed me?
So much. So
you're lying now.
Again, the top rated show was last week. It's strange this month. It's strange how that happens.
How that always happens.
I would say one thing that closed off over the weekend, it was the Olympics. I love competition, particularly best on best, and when Canada is involved. So it was great to see that over the last 2 weeks. I'm going to say my best memories from the Olympics, obviously Summer McIntosh, 17-year-old swimming phenom from Canada, coming out with 3 gold medals, the most of any Canadian athlete at any games, and 1 silver. That was awesome to watch. I would venture to guess that she may end up being the most decorated medal winner in Canadian history when her career is all said and done. Again, 17, probably has 2 Olympics ahead of her. There's a lot of events you can compete at in swimming. So it's already 4 medals. I think the largest total is 7. So she could get there quite easily.
And is that Phelps? Michael Phelps?
No, just Canadian. I'm talking about Canadian. Course, Michael Phelps has like 230. So
I was thinking in one Olympic Games.
No. Yeah, even then it's tremendously high. I mean, the thing that he has on his side is he won all the individual medals. But he also, the medley, like the U.S. is so strong across, like in terms of just volume of great athletes in every event, that you're winning relays, right? So they're winning those 2. He's winning all those 2. Yeah. But I would also say Canada, and I think we touched on this last week, is now a hammer throwing powerhouse with gold in both men's and women's events, all from the West Coast. Those two, the man and woman that won it, were from the West Coast, which is great. I think what I liked most were some of the surprise medals. The women's rugby sevens were not favored to win anything really, and they won silver. That was great. But I think my favorite moment was the men's 4x100 team winning gold. Can I quickly set the stage here, because I know you guys don't know anything about this, basically. But the Olympics had been a disappointment for Canadian sprinters to a degree, all failing to make it to the 100-meter final. Aaron Brown fouled out. Andre DeGrasse failed to make it after he had won the bronze in the last Olympics. He was also the reigning Olympic gold medalist in the 200, but he failed to make even the final in the 200 this year. So the men in the 4x100 were third in their heat to get to the final. And they had actually the slowest time of the 8 countries that were in the final race. So can anyone, you three, guess how likely it was? What were the odds of the Canadian men winning that 4x100? Was it 3-1, 5-1, 10-1? Just give me a guess going into that.
1.
I'd say like 25-1.
Brennan,
I said 10-1.
Okay.
Did you hear it?
Somehow Aaron Dunn is right. It was 50-1. Their odds were 50-1. The Americans were heavily favored, but as always, they're great individual athletes, and they botched the first baton exchange. They screwed that up royally, ended up being disqualified, the Americans. And Canada was in like lane 9, so it's on a stagger. You're running blind. You can't see. You're ahead at the start because you're staggered, but you're running blind. And it was crazy. The race, the announcers, you could tell, were stunned, because like first leg, you're like, oh, we're ahead. Second leg, we're ahead. And it starts building with the intonation and the voice. And then the secondary commentator squeals at the end. It was just great to watch. I actually watched it in the French coverage as well, and they were going absolutely even more nuts, right? But it unfolded over like 47 seconds, and I couldn't believe my eyes. I'm watching it with the family, and they're, why are you yelling so loud? I'm like, well, because they're not supposed to be doing this. So that was an awesome moment, and it made DeGrasse. He tied with Penny Alexiak, who's a Canadian swimmer, as like the highest total for men's or Olympic athletes, period. I think they're at 7. Both of them are tied. So he got the gold there. Wasn't expected to really even medal, but to get the gold. Anyways, it's cool moment when it's unexpected. It brought me back to when Donovan Bailey was running it, and they won it, I think, in 97 or so, back when Brennan wasn't even born.
Way back. So where did Canada end in the medal standings?
I think we were like 11th, 12th or something in that range, which, like, for the population size and the fact that we're not really a Summer Olympics, it was the most Olympics, most medals in any non-boycotted Olympics for the Canadian team. So yeah, good showing for Canada for sure. You guys are just all.
I mean, it's awesome. It's awesome. Can't say that I followed it too much, but I'm glad that you do, so you can.
No, it was good. It was good. And I know our listeners who tuned in for a Stock Talk podcast needed to hear about all of that. Anyways, it was great. Very satisfying to watch some of the events. Just there was breakdancing. We won the gold in breakdancing.
Oh wow!
Nice.
I don't know if Phil Wizard
Olympics that breakdancing was.
Yes, and it probably is the last.
Oh, and it's also the last. Hey?
Well, yeah. I mean, you know what? Phil was it looked heads and tails above anybody. I watched a bit of it. I mean, I'm not a breaking expert. Brennan is, so he should have watched it. But yeah, he was heads and tails, and he did a tremendous job. But there was some. I don't think breaking. It's more of a competition. They're like against each other. I don't know if it fits into the Olympic. It was tremendous to see what Phil did. He was awesome. He literally looked like a tier above everybody there. So that was cool. But there was some there that probably shouldn't have been there, in my opinion. And I don't even know much about breaking, but you're just like, what is happening there? Anyways. Okay, let's move on. Let's get to, I mean, we had a poll question, right?
Yeah, we had a poll. Yeah. So we, last week, we asked, how confident are you in understanding a company's financial statement? 11% of our viewers said very confident they understand every aspect. 74%, the bulk of our viewers, said somewhat confident I understand the required information. And 15% rounded off not confident I have minimal or no understanding, which I would expect for our viewer base. That seems about right. I wouldn't say it's any overestimating or underestimated. We do have some professionals listening, but then on the other hand, we have some first-time listeners who are really just venturing into finance in general. But I would say the bulk have at least a basic grasp of financial statements.
I think what's great is at least 75% have no clue, which keeps our jobs safe. That's what that's what we're looking for. No, but I mean, to have sometimes it's actually even more injurious to your investment portfolio to have what is a little bit of knowledge and then act on that.
Well, especially when you're overconfident, right? So
Yeah,
I was going to say probably of those 11%, was it, who said that they were very confident? Probably a lot of them, aren't that great. Whereas the 74% who said that they're somewhat confident, some of them are probably better than what they think.
Yeah.
But it's always better to be a little bit humble about your abilities.
Totally. Like, I mean, we've had, I remember, and again, I don't know if this person has voted in this poll, but this was a couple years back. We ended up doing a podcast piece on some business and it was absolutely just losing money. And we ended up getting a comment on, this our segment basically saying like, you guys don't know what you're talking about. This company is making money. And, I had to elaborate to this individual that they're basically looking at gross profit, not even operating profit or net profit. And of course, once I responded that to them, they didn't respond back to me. But, again, just kind of what Aaron's saying there, just a lot of people do have overconfidence in what they're looking at.
Well, we discussed what you're saying there, and I can take it 1 or 2 or 10 steps further. We've had several people show us saying that, no, this company is profitable, and it was based on the company issuing shares and raising equity. And yes, look, they're profitable. They have revenue.
I think we had an IR guy tell us that one
several times.
Like, we only invest in companies that are cash flow positive. He's like, oh, we're generating positive cash flow or have positive cash flow.
Yeah.
However he phrased it. And like, but you don't even have revenue. Oh, but we issued shares, right?
I know.
Yeah.
So,
geez.
Yeah, it's all levels. I mean, you know what? Like, people shouldn't be thought of to know everything about the financial industry, but there are some basic things to
For
know
sure.
if you're investing a little bit, and the difference between raising capital and actually generating revenue is probably one that you should know, particularly if you're in IR, investor relations.
Totally.
And talking about, but we're never shocked to see the lack of knowledge in basic knowledge. But.
And even for us, like when we're going through the financial statements, I mean, I know for myself, all of a sudden I'll come across a line item where I need to go to the notes in the financial statements and actually like take a deeper dive because it's maybe something that I haven't seen, or you have to kind of see like what's exactly happening depending on, what that
and
line
then you
item
have
is.
complications with IFRS and GAAP.
Exactly.
One's rules based, one isn't. Like it's not the most simple thing to look at a financial statement. So it is not surprising to see that, only 10 or 11% have some, significant degree of confidence in looking at financial statements because they're complicated.
Totally.
Okay. I think that's it for this, looking at a poll question. I'll move on to my segment. On a weekly basis, with our clients and investor interactions, we inevitably are asked whether or not company ABC or XYZ is set to report their next quarterly results, when they are. Because stock prices are ultimately driven by their earnings, these annual and quarterly reporting dates are significant days on the calendar. Some companies press release the exact date, so we are prepared in advance for that big day, but many will report without a set day. In those cases, we are able to estimate a range from past filings or communicate with management teams and they can give us an idea of a range of when those results are coming out. But we can also use drop dead dates or deadlines for the reports to be released. And I'll go over those today. So when do public companies file their quarterly and annual financial statements or their earnings statements? Let's look at Canadian public company information first. Well, to maintain a public listing on a Canadian exchange, that would be the TSX, the Venture Exchange, the CSE, A company must file audited annual financial statements through CDAR, or the System for Electronic Document Analysis and Retrieval system. Now, listed companies must also file interim, or what are quarterly, results every 3 months. These are unaudited financial statements. The audited annual financial statements must be prepared in Canada. This is in Canada, according to IFRS, and a company's board of directors must approve them. Now, in both cases, the comparative figures from company's previous fiscal year for the applicable time periods are also required to be reported. Let's look at those deadlines, annual statements. The TSX listed companies are required to file audited annual statements within 90 days of their financial year end. Venture or CSE listed companies are required to file audited statements within 120 days of their fiscal year end. Now, interim or quarterly filing deadlines, the TSX listed companies are required to file these quarterly statements within 45 days of the end of the interim period. TSX Venture or CSE listed companies are required to file interim or quarterly financial statements within 60 days of the end of the interim period. Let's just quickly look at US companies here. In the US, most companies, public companies, are required to file Form 10-K with the Securities Exchange Commission, the SEC, within 90 days of their fiscal year end. This annual report provides a comprehensive overview of the company's business, cash flow statement, and like an MD&A in Canadian markets, an overview of the business on an annual basis. Most reporting companies in the US also file what are called Form 10-Qs on a quarterly basis, or their quarterly statements. This form includes unaudited financial statements and provides a continuing view on the company's financial position during the year. The 10-K or quarterly statements are required to be filed for each of the first 3 quarters of a company's fiscal year, are due within 45 days of the close of a quarter. So that will end that brief segment, and it'll give everyone out there an idea of when the statements are required. So if you're looking at a public company, most often they will issue a press release stating, when the statements are due out. If you don't see that, you can look at the same statements. Say if you're looking at Q3 2024, you can look at their Q3 2023 to see when they were filed last year. It's likely within that 2-week range. If you're looking for a drop dead date, those dates that I just give you are the drop dead dates for them to file. Now, they can also have extensions on those, but I didn't want to get into too much detail on that. But you're looking for the drop dead dates to be the dates that I just went over.
Yeah, and typically you'll have a couple weeks every quarter where 90% or so of companies are going to release their financial results. So we just came through. Yeah. We're basically at the tail end right now of Q2 earnings season. Usually US companies are a little bit earlier, Canadian companies a week or 2 later, but it's not about 85-90% of companies are usually within that 2 to 3 week time frame each quarter.
Yeah, it's certainly a busy period for us. Yes. When we're looking over tons of financial statements. We wish they'd be more spread out. I mean, most companies are on a calendar year end. There are some companies that have off year ends. Their year ends are September 31st, for example. And you have a differing year end at that point, but that's why they say, 125 days or 90 days following. It's not just 90 days following January or December 31st, for example. Depends on where the company's year end is. All right.
Yeah, I wonder, sorry, just,
no problem.
I wonder like how long do we know, like if a company is non-timely, like, do we know if there's a specific rule of how long they have? Because the reason I bring this up is, a company that I've covered on the podcast before, Relic Health Technologies. The stock has been halted since, January. I believe they've now missed basically 4 quarters, a full year of non-timely financial statements. But as far as I understand, the stock is still halted. Again, I'm just kind of bringing this up out of the blue. On the podcast.
I mean, that can be a case by case basis, right? And in this case, the Securities Exchange Commission is hoping, like the OSC is likely hoping at some point that they come out with some financial statements. We've seen companies get halted and just never come back, right?
Yeah.
You're going through a bankruptcy procedure, or the company's just completely dissolved, right? And in that case, like in the case you're talking about, it's
quickly looking, it's if the listed shares are suspended for 12 months, the issuer may be delisted. That's according to the TSX.
Okay.
There you go.
Interesting. But yeah, like Ryan said, I'm sure case by case, but yeah, okay, that's intriguing. So I mean, again, I think that they were halted in January of this year. So I mean, still a few months to go, but yeah, we'll
it's
see.
a bit of a steaming pile, that company.
Yeah.
Let's be honest. Okay, moving on. Let's look at that. Aaron's gonna
largest investment like that.
No, definitely not.
Brendan was still thinking of making an investment now. All right, Boardwalk REIT, BEI.UN, should be no stranger to our clients, as we have had it in coverage for a number of years now, back to 2021. The units have more than doubled over that period. Again, particularly over the last year and a half, 18 months, as rates have come higher, it's been a tough environment for REITs, but Boardwalk has really bucked the trend.
Yeah, it's certainly an interesting story. And so we're going to cover Boardwalk, but really what this segment is about is really more the concept of valuation expansion. And I'll get into the definition of that. But valuation expansion it's a very important concept when it comes to financial research, stock research, particularly when you're using a GARP or growth at a reasonable price investment strategy. So we do talk about valuation or multiple expansion quite a bit. And I want to just basically clarify what it is and why it's important. So I'll just start off with a quick overview of Boardwalk here. Boardwalk is a Canadian REIT, real estate investment trust. They own and operate more than 200 multifamily residential properties. So these are apartment buildings, over 34,000 residential units. And their properties are primarily located in Alberta. It's around a 70% allocation to Alberta, around 10% to Saskatchewan, and then they also have properties in Ontario and Quebec as well. So the company's symbol is BEI.UN on the TSX. It trades today at just over $80 per unit, a market cap of about $4 billion, and it pays a relatively small yield for a REIT of 1.8%. But we recommended this company back in February of 2021. The recommendation price was just under $35. And really, I want to talk about the story and how this company has transitioned itself in the market from a stock that was trading at a significant discount to peers to one that now trades at a premium. So just taking a look at the share price since our original recommendation, as Ryan said, it's more than doubled over that period of time. So good share price performance in almost any market, but we also have to consider that since 2022, the REIT sector overall has been under a lot of pressure in the higher interest rate environment. So most REITs have not performed well in this environment, and Boardwalk has really bucked the trend there, really producing exceptional financial performance. But really what I want to talk about is the concept of valuation expansion. So we talk about valuation expansion a lot in our research. And what this essentially means is when we're looking at a company, we're always looking at profitable, cash flow positive businesses. And one way we're able to assess value is by looking at valuation ratios or multiples. So it might be like the price to earnings ratio or the price to cash flow ratio. So if a company is trading at $5 per share, has a $5 share price, they generate $1 in earnings, say, you're basically paying $5 for every dollar of earnings of that stock. So that would be a price to earnings multiple of 5. Now, when the valuation expands, that means that for whatever reason, the market decides to value that company at a higher level. So, it may have a 5 or a 10 PE multiple currently, but that multiple can expand upwards to 12, 15, 20 times or beyond. And it can also contract if the market sees more risk. So generally, the valuation expansion is the result of increased investor confidence. And this can happen for a number of different reasons. There could be a headwind that a company was facing that is no longer an issue. It could be a company that is just not well known in the market, and its market profile improves over time. It could be an improvement in financial performance, or just a recognition of the growth and the strong fundamentals that the company already has. Or it could be expectations for greater growth in the future, or just lower perceived risk. So there's many different reasons why the market could decide to value a company more favorably. And as well, we could look at the opposite of these, and if in the event that the multiple contracts, that might be because of lower growth or higher perceived risk. But valuation expansion or contraction is really an important concept to understand when you're thinking about growth at a reasonable price, because GARP investors are essentially, they're not trying to find the cheapest companies on a valuation basis, but they are price sensitive, meaning that they do look at a company's value in the market relative to other companies, and just relative to where the analyst assesses that that company should be given the fundamentals. So really, when you're conducting research using a GARP strategy, a lot of what you're doing is you're looking for a company that's a good, solid growth stock, but where there's also potential for that valuation to expand over time. And in that case, you're getting the benefit of an expanding valuation, which moves the share price higher, and then also the earnings growth, which also would move the share price higher. So this is a very powerful concept. And when you're looking at companies, if you were to look at, say, a pure growth investing strategy, which is generally not as price sensitive, a lot of times the pure growth investor is looking for a company where the growth is extremely attractive, but the valuation may also be at a very high level, a premium to the market, and in some cases a substantial premium. But the higher the valuation already is, the bigger the premium that the company already has, the less likely you are to actually see an expansion. And then the more likely you are to see future growth really just coming down to the earnings growth of the company. So just as an example, you could take a company that has $1 in earnings per share. The market is currently valuing that stock at 10 times earnings. So 10 times PE times the dollar, that's a $10 share price for that company. But say over a period of time, that company were to grow its earnings per share by 50%. Now you have $1.50 in earnings per share. Assuming there's no change in the price to earnings multiple that the market is valuing the company at, you have a $15 share price. So 50% growth, exactly the same as the earnings per share growth. But in some cases, the market can decide to expand the valuation multiple, particularly if the company is coming out with better results than expected, or again, there's less perceived risk or more growth in its future. So in this example, the company's multiple maybe expands to 15 times. So now you're taking higher earnings, you're multiplying that by a higher price to earnings multiple. And the two work together to really give you much better leverage in terms of higher share price appreciation. So in this case, $1.50 in earnings times the 15 PE would be a share price of $22.50. So more than 100% growth in the share price with the valuation expansion and with the earnings growth. Now, when we originally recommended Boardwalk back in February of 2021, what we saw was a very solid company in terms of growth. It was actually almost leading the peer group in terms of growth in its cash flow per unit, but it was trading at a significant discount. It was about 13 times FFO or cash flow. And then we compared this to what other Canadian apartment REITs were trading at that point in time. And on average, apartment REITs were trading at about 21 times cash flow. So we were looking at Boardwalk as a very financially strong company, growth oriented, up at the top of the peer group in terms of growth, but trading at a substantial discount to what the peer group average was at the time. So that was a lot of the basis of our original recommendation, is that we felt that investors were benefiting from the growth in the cash flow per unit, but also the potential valuation expansion. And this did happen. So we fast forward now to August of 2024, and now Boardwalk is trading at about 21 times cash flow, whereas the valuation multiple of the overall apartment REIT sector in Canada has actually contracted and has gone down to about 17 times. A lot of these companies are struggling a little more with higher interest rates. Growth is slowed, whereas Boardwalk has continued to grow at a very strong rate, even through this environment. So it's these two things working together, the growth in the cash flow and the valuation expansion, which have really led to Boardwalk's tremendous performance, particularly relative to its peer group. Now, why in the case of Boardwalk did that valuation multiple expand? Well, we've seen consistent growth in net operating income, including same property net operating income, which is up in the double digits right now, and growth in cash flow per unit. We have seen improved economic conditions in Alberta due partially to a recovery in the energy sector, but also high net immigration into Alberta. So there's high net immigration coming into the province, and what this is doing is putting upward pressure on rents in the province, which allows Boardwalk and other landlords to increase the rental rates. Now, just looking at Boardwalk's financials, we'll look at FFO or cash flow per unit from 2021 to 2024. We can see consistent growth here. And this actually accelerated in 2023 and is expected to be strong based on the company's guidance again in 2024. So what is our take on Boardwalk? Well, we continue to see Boardwalk as a fundamentally very strong REIT, and it has an industry-leading growth profile. So it is one of the fastest growing REITs in Canada, not just in the apartment space, but just in the REIT sector overall. The company is facing some headwinds. There's debt refinancings this year, which will be likely at a higher rate. Well, they are at a higher rate. And then as well, inflationary cost pressures. So these are issues that are not necessarily specific to Boardwalk. They're really felt industry-wide and even outside of the industry. But one of the things that I do want to note is now that the company is trading at a premium, we would have far lower expectations in terms of future valuation expansion. There really doesn't seem to be a lot of space for that valuation to move upwards without the company really becoming overvalued. Now, this could still happen conceivably if investors decided that they really like the REIT sector, or if Boardwalk's growth were to continue to improve as it has. But really, when we originally recommended it, when you're looking at a company at a steep discount that is a financially strong, growing company, you can have a more realistic expectation that the valuation will expand by a significant margin. Whereas in this case, I would really say that future share price or unit price growth of Boardwalk is really going to come down more to the growth in its cash flow per unit as opposed to any valuation expansion. So that's something to consider. But we do have a full update that we're putting together on Boardwalk. They just recently put out their Q2 results along with most of the other companies in the REIT sector. And we're actually putting together a comprehensive Canadian REIT report, which covers all 49 REITs in Canada: apartment, industrial, office, retail REITs, essentially covering all of them, looking at them all alongside each other, and then identifying our top recommendations. So Boardwalk will be in there with revised report and revised rating as well. Excellent. If I have any comments from you gentlemen, I'd be happy.
I love that one slide of the valuation expansion, like just showing, that's very, very representative for how, fundamentally businesses are valued. So yeah, just tooting.
Yeah, and I mean, we talk about it a lot in terms of like, well, why do we tend to look for companies that are trading at a discount as opposed to a premium, or even just at a reasonable price? And it's because like you could have a great company that's growing its earnings 40-50% per year, right? And it's trading at it could be trading at a huge premium of 100 times earnings, right? Well, what happens if that growth declines to 25% a year? That's still incredible growth relative to virtually any company in the market. But they're based on the valuation, the market is obviously expecting growth that is right at the top of the market. So you could still have a company growing in the double digits and see a contraction in the valuation because there's so much expectation baked in, and that 100 times price to earnings multiple can drop to 50, which is still a big premium. But that's an example of where you can see a company that continues to put out strong performance, but actually has poor share price performance. Whereas where you are buying reasonably valued companies or undervalued companies that still have strong growth-oriented businesses, there's just a far better likelihood that you're going to see the valuation expand as opposed to contract, assuming you pick them properly, of course.
Yeah, and that's really when you hear that phrase, the growth is priced in, that's what you're coming down to, is when you're looking at those companies that are 100 times sales or something like that. That's what analysts, us or other analysts, mean by the growth is priced in. It has to hit that high growth percentage, whatever it may be, year over year. And if not, then that multiple will contract. If it goes down to 20 times, there's 80% of your share price gone if all else stays equal.
Mm-hmm.
Yeah. And those are the cautionary tales. On the flip side, what you're looking for is a company that doesn't have the growth priced in, right? Like that you're forecasting 30% growth and it's trading at 10 times multiple, and there's a good balance sheet. And that's where you get, where you have Boardwalk, which is likely a few years ago mispriced, trading at a discount to the sector, and then growing beyond the sector, and then gets a higher multiple over time. And that has happened with, some of our greatest winners, like the Hammond Powers of the world, that traded at a massive discount to the overall markets, was growing well above over the long term a market rate of return, and eventually got rewarded, and then started growing above that rate, then got rewarded with a premium multiple. So you went to a discount to a premium and significant growth in the underlying EPS. That's how you get a true long-term winner in the market. And that's, that we've seen that. We saw that with Boyd, we saw it with Expel, Hammond Power, many of these companies. It's not only just their earnings powering it, but the multiple expansion, like Aaron talked about that. All right, let's move on to, I believe Brett is going to look at what company you're looking at today, Olympia, if I can say it correctly, right? Not Olympic. I've got Olympic on my mind, right? So it's Olympia.
Yeah, well, it's same origin of the name, I guess.
Yeah. Coming from the same area, yeah.
Yeah, so we got a question on Olympia Financial. They stated that it's underfollowed, profitable Canadian financial company with a high dividend, well covered by income, but terrible liquidity. It's mostly ignored even by Keystone. I will do a slight correction on that. We did actually highlight it in our 2024 Dividend All-Stars. We had a small highlight and all that. Not a significant highlight, but we do know it existed before this. So, Olympia Financial Group, symbol OLY on the TSXV Canadian Financial Services Company. The company breaks its operations into investment account services, private health services, currency and global payments, exempt edge division, corporate and shareholder services, as well as they have a corporate division as well. Then investment account services, which manages over 10 billion assets, provides services for registered accounts like TFSAs, RSSBs, and so on. With a focus on exempt market securities, which are just private companies, really, not non-listed companies, so non-exchange traded companies, as well as arm's length mortgages, which is the really differentiator. Most companies in financial services generally focus on public companies, but they focus on private companies and really allow smaller investors to gain access to them. As well, I will mention the company receives interest on cash, the cash portion of these accounts, as it makes up a large portion of their revenue. The stock has performed well over the past year, up 16% to $100 flat a share, a nice round number, and a $242 million market cap with a nice dividend yield of 7.2%. Diving into the Q1 income statement, service revenue was up 3.5% to $12.3 million. Trust income, which is derived from the combination of interest, the interest rate, and the trust size, with the cash in the trust side, rose 17% to $13.5 million, with the interest rate component being the major driving factor, resulting in total revenue growth of 9.4% to $25.8 million for the quarter. Net income grew 9.8% to $5.7 million. Effectively, net income grew in line with the total revenue growth, as there were no really massive shifts in operating expenses during the year. There was a slight uptick in administrative expenses, and that's happened in the last few years, but not any significant change. EPS grew to $2.39 with no change in share count over the past year. So nice share structure as far as that goes. Shifting to the balance sheet, it appears to be strong. $25.1 million in cash, $3.6 million as a liability as a revolving credit facility, and another $900,000 or so in leases, resulting in just over 20 million in cash. However, though, I will point out the company does actually have a significant deferred revenue liability, and this relates to the annual registered plan services admin fees being received at the start of the year, so they receive the cash. They can't recognize the revenue yet, so it creates a liability, and that had occurred in previous years as well, so it's really just a quirk of the operations. You should be, it's not inherently bad or good, it's actually normally can be seen as a good thing as they get the cash up front. It's prepaid effectively, but it's something which you need to be aware of because it inflates their cash at the start of the year. And then, as you can see in the graph I have, it kind of goes down throughout the year. It trends down throughout the year. Q1, it will pop up, then it comes back down. And that's happened year over year. And there's obviously some noise in there, but it's a major driver in it. We can see this in the last quarter. When you compare it to year-end cash, it increased about 14 million that in the one quarter. So the balance sheet is by no means weak, but it's not as strong as it, you just seeing that strong cash balance with really no debt, minor debt, I should say, compared to other companies where they may have a significant debt or a net debt position. I will want to focus on how important the high interest rate environment has been for Olympia. The company states its interest rate sensitivity for a 1% movement for the quarter would result in an increase of 2.04 million and a decrease in income of the same amount if the interest rates fall by 1%. Looking at the prime rate over time, which is what they borrow at, and that's what they quote, they don't actually give their effective interest rate of what they earned on the trust holdings. So I'll just use the prime as really a graph over time, and it's variable. So there we go. You can see we're at a 20-year high, and if we say drop 3% to roughly the pre-pandemic level, the company will lose 3 million in net income a quarter, which, if you recall, that is more than the 5.7 million total net income in the last quarter. So quite a bit of interest rate risk. Given the recent moves by the Bank of Canada to cut interest rates and the continued expected rates, if it were to fall back down to those pre-pandemic levels or even below that to 3% like it was during the 2010s, that could actually put the company into a net loss position given its current interest rate sensitivity, which those are their numbers, I should say. Whether or not there's normally some other movements or some offsetting movements, but I'm quoting their numbers, and it's not necessarily lost if it did drop 3%, but that's what they're stating at this time. Now, looking at the dividend, the company pays a 60-cent monthly dividend or $7.20 annually, resulting in a nice yield of 7.2%. The dividend was raised substantially in 2023 from about 27 cents at the end of 2022 to the now 60 cents, so over doubling it during this time. And prior to that, they had a quite flat period, but they previously raised over time. Based off the most recent quarter, as well as the prior quarter was roughly about the same, bit lower. The most recent quarter, the payout ratio was 75% of net income, which is quite high after raising its dividend, but it's not absurd for a financial company either, but you do need to take notice of it once it's getting that high. It is something you need to be conscious of, as if earnings do start to drop, that can put the dividend at risk quite quickly. Shifting to a quick valuation, the company trades at 10 times earnings, or a P of 10 times, as well as a 10 times cash flow over the past year. Given the recent growth, it would seem like it's undervalued, but I would like to note and emphasize this is primarily due to interest rates rising over the past couple of years, and now we're seeing the trend reverse. So going forward, I would not be surprised if earnings actually do start to decline, just given due to their interest rate sensitivity. So wrapping things up, if the interest rate stays steady, or the highest rate of interest rates that have been over the past year, it's been really driving the earnings. Continued, the company would likely be undervalued, but that's probably not the case given the macroeconomic backdrop. The company's really benefited handsomely from these higher interest rates, but that growth has not been seen in its services revenue at anywhere the same rate. During the last couple of years, admin expenses have also increased, so that's your employee cost effectively, at a higher rate than service revenue, so they're spending more on their employees at a higher rate growth than compared to their service revenue. And that's really what they have control, is their service revenue more than interest rate revenue. They can, of course, increase the trust cash amount and the oversized size of the trust asset, and that is something which they can do. But as they've stated in many of their news releases and management commentary over the past couple of years, it's almost all due to interest rate. I would expect the trust to be growing roughly in rate with the size of their service revenue growth at 3-4%, which would make sense. So Olympia's net income could very well be in a worse place than what it was before the pandemic due to that. if the service revenue does not start to grow in the near future, which is higher admin costs. Further, the company does have a significant payout ratio during the last couple of quarters at the 60-cent monthly dividend. So if EPS contracts, the dividend could potentially be at risk getting cut back down to that lower rate. It did increase very quick, very substantially. Maybe they didn't want to they didn't have another effective use of cash, so they handed it out to shareholders, and they plan to reduce it when they need to. Some companies would do that. That is something I would look into it if I were to want to invest. But really, to summarize the bull case for Olympia, you need to have higher interest rates for longer to support that 7% dividend, and for it to allow the service revenue to grow over time at that low single-digit growth rate. Meanwhile, the bear case is really a dividend cut, lowering return, and it would likely cause the market to reprice the company, resulting in capital losses. So really, the trade-off doesn't seem appealing to me, given the current macroeconomic condition of we're in really a cycle of rate cuts now, and we're starting to see more expectations and higher expectations for cuts in the US, and as well as Canada continues to look to cut. So I really just pass on Olympia for now, as it is just so interest rate sensitive, and that other operations aren't growing at the same rate to make it appealing.
Yeah. I mean, like looking forward, like if interest rates decline, what could that forward, earnings multiple be? 13 times, 14 times, if we did see, earnings drop. Again, I'm sure we'd be able to, actually do some napkin math basically just on what they provided by if there is, that 100 basis point move. But exactly that. It's interest rate sensitive. And if we see them come down, earnings are going to drop.
Yeah, and I'd agree that on the valuation, so 10 times, even if you were to take that 10 times multiple, relative to most stocks, that's fairly attractive. But, relative to most financial companies, like say the banks, they're mostly trading at less than 10 times, right? And you'd have the opportunity to get a much more diversified name that's actually less interest rate sensitive potentially. So
Yeah, and there's a smaller cap bank that we're recommending right now that has significantly higher growth path ahead of it that's actually trading at below the 10 times multiple as well. So Olympia, there's some pluses there, but it's always it's relative to what else you can buy in the financial sector as well. And there's some other names that we like right now ahead of that company. Okay, let's look finally at Trigon Metals, TM on the TSX Venture. Brennan, you're going to take this one. We had a viewer question on it who stated that, it's lining up to be a potential 30 bagger. So you can take us through that.
You betcha. So yes, this came in from Steven via email, and he says, I'm curious what your guys' opinion is of Trigon Metals. It's a copper mine that closed a long time ago due to mismanagement. It has now reopened under new management, and they've transitioned recently from the low margin open pit mine to focusing more on underground mining. If they achieve what they say, it could easily be a 30 bagger, it would seem, and much of the risk has already been removed, it seems. The stock seems dirt cheap. What's your take? So Trigon Metals, TM on the TSX Venture, currently trading at a price of about 85 cents with a market cap of 38 million. And again, like Steven says, they are a copper miner, which holds an 80% interest in its flagship project, the Combat Mine property, which consists of 5 mining licenses and 2 prospecting licenses located in northern Namibia. Now, something to quickly note is just that the company did do a 1-for-5 share consolidation in May of 2024, bringing the company's outstanding share balance down from about 218 million shares to about 44 million today. Now, the Combat Mine originally opened in 1961, and between 1962 to 2007, it produced about 12.5 million tons of ore, but closed due to low copper prices and underground flooding in 2007, or at least that's what I could find. However, with renewed interest, Trigon has placed a current expected life of mine of approximately 15 plus years on the Combat property with a new strategy. And looking at the mining strategy, so Trigon's strategy with the mine has been restarting the open pit in May of 2023, which is in production, with the second phase being the reopening of the ASIS West underground mine, which has been ramping up since February of 2024, which starts with the ASIS West Shaft complex and thereafter moving on to the ASIS Far West Shaft into 2025. Now, the company also plans to expand the mill's throughput from about 30,000 tons per month to about 60,000 tons per month in order to have the capacity ready to increase throughput for additional material from the underground operations. But I will note in the company's MD&A, they noted that they anticipate raising further capital to fund its development of ASIS West and the proposed mill expansion. They also note in the MD&A that they expect to continue to incur losses in the near term as it ramps up its mining operations, and that there can be no assurance that the company will generate any profitability. So keep that in mind. Now, if we look at the company's copper production guidance into 2025, they are projecting to do about 12.5 million pounds of copper production with a C1 cash cost of about $3.15 to $2.80 per pound. And looking forward to 2026, they're looking at scaling copper production upward to over 30 million pounds and then up to 69 million pounds in 2027. Now, one thing to understand about C1 cash cost is that while they are guiding it to be from about $3.15 to $2.80 per pound in 2025, which in theory gives them some leeway with the volatile price of copper as copper trades in the $4 range, it is important to understand that the C1 cost metric does not include costs like capital costs for buying, maintaining, or upgrading equipment and buildings, corporate overhead costs, or any other costs not directly related to production. So whether the company will generate or begin to generate net income is still a little unclear to me. And I would really like to see a few quarters in 2025 to see what kind of progress they're actually making on the bottom line. Now, moving to the most recent financial results for fiscal year 2024, keep in mind the results are in US dollars. So revenues were 9.6 million for the year, but the company actually posted a gross loss of 1.1 million, which again is before any other operating expenses. And on the bottom line, the company posted a net loss from continuing operations of about 1.5 million for the year, but the company had a $10.7 million accretion adjustment to its Sprott royalty following the release of its updated feasibility study. So if we remove that artificial gain, the net loss for the year would be, closer to the $10 million mark. Cash flow from operations was a loss of 3.3 million. And quickly just going over the balance sheet, as at March 31st of 2024, Trigon had cash of 1.4 million with no debt, but they did have leases of 5.1 million, which is primarily for equipment financing. And I'll also note that the company has negative working capital of about 8.8 million, which again is somewhat of a concern, especially as the business needs capital to expand. So to conclude on Trigon, I think the growth story here is intriguing. Management has a plan to increase copper production significantly over the next few years, but I don't think that it's a free lunch to 30 bagger land by any means. And personally, I think that risk remains very high, and I don't really think that it's de-risked, as Steven says. Now, in theory, if the price of copper remains elevated and management can execute on their guidance and produce bottom line profitability and cash flow, there's certainly a speculative case to be made for the stock. But again, the company is relying on a volatile commodity, and there remains significant execution and operational risk from management on whether they will be able to achieve their targets without running into any hurdles, which obviously, are quite prevalent in the mining sector. Plus, as it stands right now, I do not have a clear indication that the business will be able to generate profitability, and it will likely need to raise additional capital to expand its underground mining and its mill from 30,000 tons per day to 60,000 tons per day. So all in all, this is not the profile of a business which we would classify as a 30 bagger or even a 10 bagger at that. This question is quite timely as we do have a new upcoming webinar series at the end of August and into early September, focusing on stocks with the profile of a 10 bagger potential. But again, the story sounds good on paper and in Trigon's presentation. But I would like to see a few more quarters to see how they're actually pacing or tracking toward their guidance and whether they can achieve that bottom line profitability. So as it stands, it's not a stock which we would recommend at this point, and not a business that I think will provide 10x returns with low risk.
Yeah, I think you need some operational cash flow before it's
Mm-hmm.
de-risked
Yeah.
towards any type of positive return. So, like a 30 or a 10 or a 100 or whatever times multiple, 20% higher. It has to be powered by actual underlying cash flow. Now, you could project that out based on their guidance, but again, it's based on a volatile underlying commodity too. They could produce at the cash cost they're producing now. Copper goes well below $3, which it has,
Yeah.
and you suddenly you don't have a profitable business, even if production is ramped up and costs are kept in control. So that we often looking at metals companies or commodity based businesses as more trades than in long term investments, and we don't trade a lot, so most of our investments are outside of this segment. There are some ways to play these segments. We had a company that is a driller. It doesn't necessarily drill for copper, but they came out with results today. The stock was up 15% because the results were tremendously strong,
Mhm.
and it is a way to de-risk yourself from getting some exposure to the say the gold sector, because they're drilling for 20, 15, 100 companies, and it spreads your risk out across those companies. And again, that there is ways to play commodity based businesses that are less risky than the one or a commodity based business strictly that just drills for an underlying commodity, or sorry, produces as well as drills. And this company really is just in the initial stages, so certainly not
Yeah.
de-risk at this point.
Yeah, exactly. And like that's the thing. I mean, we'd love to see a little bit of indication of profitability rather than just going off of, targets and guidance. It would be great if, they actually had a cash rich balance sheet, which is obviously something that we love when it comes to a commodity based business. Not only would they maybe able to actually fund internally the new mill and the expansion of the underground, but it would make it so they don't have to, go to the market potentially and issue shares. I think the last time that they issued shares was in July of 2023. I'm pretty sure, from my research there, my quick research. But I would anticipate that they will likely have to go back to the market
And this
and raise.
company's already shown it will issue, and has
Consolidate.
consolidated
Yeah.
again. That is the pattern with most of these companies, and it's very difficult to uh, you know make a long-term gain when you're being consolidated.
Yeah.
Its dilution is significant. So there is, even with a company that had in this sector cash in the bank, a profitable existing mine, there is no de-risking. They are high risk, these
Totally.
type of businesses. So yeah, we would not say, and I get what is being trying to be said by the de-risking, but there is high risk is what we have to say, just generally in these business, just operating even a well-run great project that looks great. And I don't think this project is there yet.
As well, just furthering on top of that, Namibia, it's a geopolitically risky area. It's not by any means the riskiest in Africa, but it's still a
No.
risky region of the world.
Totally.
So you got to add that on top of the usual commodity stuff which we've been talking about.
Yeah,
Yeah.
for sure. Adding some significant geopolitical risk for sure. All right, I think that's gonna end our show for this week. Keep your questions coming in for our Your Stock, Our Take segment, and we'll endeavor to answer those on a weekly basis. Look for that email on our upcoming webinar, how to find the next 10x stock based on profitable small cap growth companies. We'll have that to you ASAP. If you are viewing this right now on YouTube, rate and review, smash that subscribe button. If you're listening to this, wherever you consume your podcast, rate and review us. And as always, I'd like to wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.